Hello and welcome to C&C Markets on Friday the 15th of June and another special edition of my weekly market update. And once again I'm pleased to have Megan Greene from Rubini Global Economics with me today. We do one of these per quarter to discuss essentially the soap opera that is the European sovereign debt crisis. And since we last spoke, Megan, obviously Spain has jumped front and centre into the crosshairs of policymakers. We've obviously got the Greek election this weekend, and we've had central bankers basically come out last night, I believe, and talk about a prospective concerted stimulus push next week in the event that we don't get the result, or markets don't get the result that they want at the weekend. Now, we've had the first Greek election, that was inconclusive. We've seen the emergence of Alex Tsipras from Syriza. Does he really sort of act as the threat that policymakers think that he does, or irrespective of who gets into power, EU leaders are going to have to bite the bullet and deal with him?
Well, I think that Alexis Tsipras from Syriza has a similar message to New Democracy, which is, of course, the party that would be considered a good result in the Greek election if they won. In that both parties actually want to renegotiate the bailout package. Both parties, whoever wins, their hands will be completely tied by whatever the Troika is willing to concede on the package. I think the style of the two different parties and the two different leaders of those parties is very significant in that Alexis Tsipras has really been more of a renegade politician. He doesn't wear a tie anymore. He's trying to be, trying to speak to the people and gain from this anti-bailout message that he's been promoting, whereas Samaras, the head of New Democracy, is more of a statesman, is more willing to negotiate with the Troika. No matter who comes first in this election, I think that the coalition that will ensue will end up finding a compromise with the Troika, though. So I don't think that Greece is going to face an imminent default or Eurozone exit. It's in everybody's best interest for both sides to find a compromise. I mean, Greeks want to stay in the Eurozone. If they were to default now with a big primary surplus, primary deficit that's probably growing, in fact, they would be forced out of the Eurozone. So it's in their interest to buy some more time until they can at least find primary balance, so they might have some chance of defaulting within the Eurozone, given that they want to stay in the Eurozone. And from the Troika's point of view, Spain is in the middle of the crosshairs of this crisis right now, and they would like to buy time for Spain and Italy to be ring-fenced before they're willing to cut Greece loose. So I think we'll see some dangerous brinkmanship in the negotiations up ahead between the Troika and the new Greek government, but I do think that they'll find a compromise. And we're just entering a new period in Greece where we have elections, more austerity measures, social unrest, and new elections. So whoever forms this government in Greece, I think will fall before the end of the year. We'll have new elections again, and then a few months later, until we have a government in place that is willing to consider the alternative to this current plan of retrenchment and bailouts and depression, and is willing to actually consider leaving the Eurozone.
With that in mind, Jens Wiedmann this morning has said that there is no scope for further renegotiation of the bailout, so you're essentially saying that's a negotiating ploy on the part of him to try and get the government in Greece that he wants, and that there is actually room. And if they do renegotiate the bailout, what does that obviously mean for Portugal and Ireland?
I think it depends on what they renegotiate. If Greece gets, a lower interest rate, I do see Portugal and Ireland coming up next and saying, how about a lower interest rate for us? I think what we'll see is a relaxation of some of the fiscal targets, more likely. In private conversations with top members of the German government, they'll admit that the second bailout is an absolute mission impossible for Greece. The targets are completely unrealistic. And so I think more of what we'll see in terms of a compromise is how front-loaded this program is and how quickly Greece is being expected to make the adjustment it's having to make. In which case, I don't think that Portugal and Ireland will come asking for the same deal, particularly because those two countries are actually hitting their targets. So I think that they'll continue to try to show that they're the model students and that they're succeeding with their programs, even if the programs really are killing the patient in both Portugal and Ireland and are pushing both countries into recession.
So a third bailout possibility?
We might
Greece?
see a third bailout. I think more likely we'll see official sector involvement, so we'll see a restructuring of the debt held in the official sector for Greece. I expect Greece to put in place a government willing to exit the Eurozone as early as the beginning of next year. So that doesn't actually leave that much time for things like a third bailout or official sector involvement. But I do think we might see a further debt restructuring on officially held debt. But, you know, in 6 months' time, I think we'll see the government choose to exit the Eurozone.
So all these fears about this weekend's events probably going to be slightly misplaced. We're not going to see an imminent Greek exit. They're going to kick the can down the road and really focus their attention on what is a much bigger problem, Spain. Now, obviously, this week's banking bailout had a half-life of about 4 hours, and Spanish bond yields have hit 7%, and Mr. Rajoy is starting to ratchet up the pressure. What's next for Spain?
I think the Spanish sovereign will inevitably need a bailout for a couple of reasons. You know, Spain's public debt situation is completely unsustainable given Spain's growth outlook for the next couple of years. But even worse is Spain's external debt situation. If you look at external capital in Spain over the past 4 months, it has positively flown out of the country. And so the only way to plug that gap is to either have foreign investors piling money back into Spain, very unlikely these days.
Uninvestable, I think, springs to mind for both Greece and Spain, so we need to come up with something.
Exactly, or Spain can boost its exports significantly, but given the global environment, I don't think that's likely. Or you can have official financing come and plug the gap, and that's what we're going to see. Now, it's hard to figure out the trigger for a sovereign bailout in Spain. A lot of analysts have said, well, you know, 7% is the magic yield, after which all the other bailout countries have needed a bailout. There's no magic number, really. But I do think we saw Spain downgraded by Moody's recently, and most people really don't care what the credit ratings agencies think, but in Spain, actually, it makes a huge difference because in Spain, you've got mostly banks, Spanish banks, buying up Spanish sovereign debt. And to participate in ECB repo operations, Spanish banks are having to post collateral, and they have to post more collateral as they're downgraded. And Spanish banks are running out of collateral. So they're running out of collateral to use to eventually buy up Spanish sovereign debt. So we're going to see bond yields rise further and further. We might see the ECB step in after the EU summit with its security markets program to try to relieve some of the pressure. But I think that might only help on the margins and very temporarily. So I do think we'll see a bailout for the Spanish sovereign, if not this year, then at the beginning of next year.
I think you articulated in your last chat with me that if they did restart their SMP, because of what happened in Greece with PSI, that the subordination factor could come into play. And obviously they're also talking about another LTRO. That's not going to work, is it, either, because they're going to have to lower their collateral requirements again. And I think that if the housing market in Spain continues the way that it's going, the quality of that collateral is going to become less and less.
That's absolutely right. And further LTROs, you know, in the US, when you had Lehman collapse, first they had term financing, and that's what the LTROs are, and then they moved on to other kinds of operations. And I think further LTROs won't really make a huge difference in the Eurozone, though they could help to finance the bank run that we've seen over the past couple of years. So far, the ECB's just been financing the run with emergency liquidity assistance programs, ELAs, or with the LTROs. So if we do see a bank run kickoff in the periphery in the Eurozone, we might see more liquidity operations by the ECB.
Isn't that already happening now in the periphery in Greece and Spain? You're seeing net capital outflows as part of the Target 2.
Yep, that's absolutely right, and the ECB's just been financing it. And the ECB will continue to finance it, and I think governments will be happy for the ECB to finance it, but at some point the ECB might take the punch bowl away over concerns about the integrity of its own balance sheet and also about its independence. So, you know, for now I don't see that happening. I think we'll see further ELA programs also for Spain and Italy going forward, and we may see further LTROs. The bank run really has been going in Greece for a while. In Spain, though, it's mostly external deposits that are leaving, so I think it's slightly less of a concern now, though if we do see, or when we do see Greece exit the Eurozone, I do think that contagion would be spread primarily through a bank run.
Okay, big as Spain is, Italy is an even bigger problem. Now, Mario Monti's honeymoon appears to be over. He's losing support in the Parliament, and his reform programme appears to have stalled. And I think, the markets are thinking that, if Spain does need a bailout, and it probably will have a bailout, then Italy is next. Can Monti do anything to put that off?
Not really. Unfortunately, the fundamentals in Spain and Italy are very different, but the markets aren't discerning between the two really at all. And I don't think politically Monti can do anything to accelerate the structural reform program or to strengthen the labor market reforms, which are really key in Italy. So I think that, unfortunately, once Spain gets a bailout, attention will turn immediately to Italy, and I think Italy will be right behind Spain. Also, don't forget that Monti's lost popularity, and he's stalled in terms of implementing the structural reform program. He has been better than, any Italian prime minister in decades in terms of trying to implement an aggressive structural reform program, but we're looking at Italian elections at the beginning of next year, and so he's not going to be in power for very long. And Italian political parties right now are in complete disarray. It's not clear who will win, but we can expect some kind of gridlock in the next Italian government. So we're concerned about the pace of structural reform implementation in Italy now. It's only going to get worse from here.
So the outlook for Italy not so good, and of course we've got a change of dynamic in the Franco-German relationship with Michel Hollande, and he's sort of sided with Spain and Italy in putting pressure on Germany to bail out his banks, essentially, because who's got the biggest exposure to Spanish and Italian debt? French banks. So they've been talking about Euro bonds, off the table, stability bonds, off the table, bank mutualisation, off the table. So really, Germany said 999. Is there a possibility they could say yes to something else? This redemption fund that they've been talking about. Could you elaborate on that?
Yeah, we could see Germany agreeing to a European redemption fund, and essentially it would be mutualizing debt above 60% of GDP for each of these countries, but only for a limited period of time. So it only lasts for 20 years, and that means that you don't have to, re-ratify the treaties. It means the German Constitutional Court might accept it. There does seem to be some momentum behind this, but of course, baked into this redemption fund is the idea that countries have to, over time, over the 20 years, reduce their GDP their public debt to 60% of GDP. Now, Italy's public debt right now is 120% of GDP. I don't know anyone who thinks Italy can actually have that over the next 20 years. Even for Spain, which has a lower public debt burden, it's going to be impossible to actually hit the targets that are baked into this redemption fund. And if countries can't hit the targets in the redemption fund, they get kicked out of it, at which point, they're going to have to restructure their debt. So it could buy a couple years of time, actually, for Spain and Italy, and it would be set up, particularly for Spain and Italy. But it only deals with the fiscal piece of this puzzle. It doesn't deal with the banking crisis. It doesn't deal with the balance of payments crisis. So, it's not a comprehensive solution by any means, and I think there are huge concerns about its implementation and about whether anyone can actually meet the targets that are baked into it.
So it's not a silver bullet, and it could well be just a red herring.
That's right. And, well, a red herring, but it could buy some time. And, that is what the Eurozone needs more than anything else is time, although it depends on what they do with the time that's being borrowed for them.
But there's no growth, unemployment's rising. How much time do they really have if they stick to the fiscal compact and Germany refuses to budge? And to be quite honest, Germany budging, they're not alone in not budging. I can't see Finland going for it, I can't see Austria going for it, and I certainly can't see Holland going for it. So
That's right, absolutely. I don't think that this could work. And in fact, the targets that are set up in the European Redemption Fund just ensure that these countries will go even further into recession. The adjustment they have to make is so big, not to just stabilize their debt levels, which already isn't feasible, but to reduce them over the next 20 years. So it can't work, but in the short term, in the next 2 to 3 years, they could avoid a debt restructuring, which I don't think they will succeed in doing otherwise.
So essentially what you're saying is we're going to have to get used to more market turmoil, more bouts of instability as European leaders strive to basically kick the can down the road even further so that they can ring fence the bigger economies with the potential of pushing the smaller economies out.
Yeah, that's right. It's amazing how much hasn't changed in this crisis over the past couple of years.
So that's it, more of the same. So thanks once again to Megan for coming in. She'll probably be back in another 3 months, and we'll probably be talking about the same old issues. Once again, thanks very much for listening. This is Michael Hewson and Megan Greene talking to you from CMC Markets.